Hey everyone, this is Deep Dive Stock Earnings. Today we're going to break down Nvidia's latest earnings report. The numbers just came out. The stock jumped more than 4% after hours. And I know a lot of you are asking the same questions. Nvidia is already this expensive. Is it still worth buying? Is it peaking? Is AI turning into a bubble? So today I'm going to walk you through this whole earnings report in the most direct, simple, no BS way. I'll tell you whether Nvidia is expensive right now, whether it still has room to run, and a few key risks you absolutely need to pay attention to before you make any decision. Alright, let's get into it. First, let's talk about the numbers themselves. Nvidia's revenue this quarter came in at $57 billion. Wall Street was looking for $54.5 to $55.5 billion. So this wasn't a tiny beat. This was a clean and decisive beat. EPS came in at $1.30. Market expectations were around $1.23 to $1.25. Another solid beat. Just the numbers alone were enough to push the stock up after hours. But honestly, the more important thing is the gross margin. This quarter's gross margin came in at 73.4%. Yes, that's about 1.2% lower year over year. But quarter over quarter, it's actually up 1%. And you have to understand something. When a company grows this fast, gross margins almost always drift down. The bigger the business gets, the harder it is to maintain efficiency, and the cost structure usually becomes more complex. But Nvidia is growing like crazy and still holding gross margins above 73%. That alone is pretty insane. Now let's look at growth. EPS up 67%, net income up 65%, revenue up 62%. These numbers aren't growth. These numbers are explosions. And right now, there's zero sign of slowing down. This is also why all the AI bubble talk got quiet really quickly after this earnings report. So where is Nvidia making all this money? The biggest driver, no surprise, is data center. Data center revenue jumped 66% year over year to $51.00 billion. This is Nvidia's strongest, most profitable, and most important business right now. Basically every company doing large-scale AI training is using Nvidia hardware. That's just the reality. Networking revenue grew 162%. And even though the base is smaller, this segment is becoming more and more important because modern AI workloads don't buy one GPU, they buy the entire infrastructure. Gaming only grew about 30%, but honestly, Nvidia is no longer a graphics card company. It's an AI infrastructure ecosystem. So the big question is, how long can Nvidia keep this up? How many years can this kind of growth continue? And here's the truth. As long as data centers around the world keep expanding, and as long as AI workloads keep increasing, Nvidia is going to have demand coming in non-stop. Look at the US, look at Asia, even the Middle East is talking about building massive AI facilities inside these huge data centers. Rack after rack is filled with Nvidia CPUs. And here's a key point a lot of people overlook. CPUs have a life cycle of roughly 5 years. After 5 years, they need to be replaced and upgraded. So every chip sold today basically guarantees a second wave of revenue down the road. This is Nvidia's biggest moat. But we also have to talk about risk. The first major risk people love to bring up is AMD. AMD has made some real progress. Their new accelerators are cheaper. And if the performance closes the gap over the next few years, they really could take some market share during the next big upgrade cycle. That is, without question, Nvidia's biggest long-term competitive threat. The second risk is the whole AI circular financing debate. Some people believe these AI companies are running an internal money loop. They invest in each other. They buy from each other. The money circulates within the same group of players. This isn't necessarily a bad thing, but if even one major company's earnings suddenly slow down, market sentiment could turn instantly. I see this more as a sentiment risk, not a business risk, but sentiment matters when it comes to stock prices. Now let's talk about Nvidia's financial structure. Honestly, there's almost nothing bad to say here. Revenue strong, EPS strong, free cash flow strong, ROIC insanely strong, debt structure healthy, valuation high, but not crazy given the growth. From a financial quality perspective, Nvidia is one of the strongest companies in the world right now. Now let's talk valuation. Based on my own model, including a 30% margin of safety, Nvidia's intrinsic value comes up to around $163, and the stock right now trades around $196. What does that mean? It means short term, Nvidia is a bit expensive, roughly 15–16% above my fair value. But here's the key. That valuation assumes Nvidia's growth slows down. If Nvidia keeps growing 50–60% like it is now, this price is totally reasonable. But if growth drops to 20%, or even 10-15%, Nvidia's intrinsic value drops fast. So the real risk here is not earnings, not management, not the business model. It's the sustainability of growth itself. As long as Nvidia keeps this pace, the stock is safe. The moment growth slows down, valuation compresses instantly. So here's my conclusion. Nvidia is an incredibly strong company. It's not going anywhere. It will be at the center of AI for the next decade, easily. But at this price, my rating is hold not buy. Not because the company has problems, but because the stock is priced for perfection. And perfection is always dangerous in tech. If you already own Nvidia, great, hold it. If you want to buy right now, I'd say do it slowly, in small batches, not all at once. What do you think about Nvidia? Do you think it's expensive? Or do you think this growth continues for another 5 years? Tell me in the comments. This is Deep Dive Stock Earnings. Thanks for watching, and I'll see you in the next one.